Welcome back to the deep dive. Today, we're going to try and cut through, all the noise of modern finance.
We're going straight to the source.
Exactly. We're going to uncover the enduring blueprint of one of the greatest investment minds of the last century, Charlie Munger, the legendary vice chairman of Berkshire Hathaway.
A fascinating figure.
Truly, our sources today are centered around David Clarke's compilation of Munger's philosophy, his quotes.
Okay.
And it's a great collection because it presents this core mystery that we need to unpack for you. Munger trained as a meteorologist, then he became a very successful lawyer. But the thing is, he never took a single college course in finance or economics.
Not one. He came at it completely fresh. No traditional playbook.
So how did this man become the intellectual architecture behind Warren Buffett? What is this non-traditional playbook that made him so successful?
And that blueprint, that's exactly our mission today. We are looking at this foundational shift that really defined modern value investing.
It's a huge shift.
Huge. Warren Buffett himself called Munger's influence his most important architectural feat. For decades, Buffett was operating strictly under the old Ben Graham rules.
Buying fair businesses at wonderful prices.
Right, buying cigar butts, things that were cheap, rock bottom. But Munger fundamentally disagreed with that approach.
So he changed his mind.
He forced a complete change. The new rule, the philosophy that defines Berkshire Hathaway, was to, and this is the key quote, buy wonderful businesses at fair prices.
Okay, so that's our goal. Unpacking the pillars of this wonderful business idea.
That is the shortcut you need to take away from this dive.
All right, so let's unpack that journey. From Graham's cheap but fair businesses to Munger's high quality at fair prices. It starts in Omaha.
It does. Munger was born there in 1924. And in this great little bit of foreshadowing, his first job was working for Warren Buffett's grandfather.
No way.
Yeah, at the neighborhood grocery store. So he was learning the basic flow of money, of business operations, right there on the floor as a kid.
That's incredible.
That early exposure to the nuts and bolts of commerce was key, but so was the discipline he picked up later in the Army Air Corps.
Right, the poker.
The poker.
Yeah.
While serving, he'd play with his buddies. And that taught him this core decision-making strategy that you see in everything he does in finance.
Which was?
He learned to fold his hand when the odds were against him and bet heavy when the odds were with him.
That discipline, that clarity about risk and advantage, you can see how that would become the foundation for his entire style.
Absolutely.
And that same decision-making discipline, it eventually led him to realize that law was, well, a dead end for his ultimate goals.
He was good at it, but it wasn't scalable.
Right. He famously said his first $1 million was the hardest money he ever earned. He just recognized he would never get really rich practicing law. He needed a vehicle for compounding.
And that search led him to a really pivotal lunch meeting. I think it was the summer of 1959.
The famous meeting?
Yeah, that's the one. Munger was back in Omaha settling his father's estate, and a couple of old friends introduced him to a young man named Warren Buffett.
And they just clicked.
Instantly, talking stocks, business, strategy. And that meeting launched one of the most profitable and longest-running business partnerships in history.
But their early days were, well, they were a huge contrast to the cautious, conservative approach we know them for now.
Oh, completely.
Munger's first investment partnership, which he ran from 61 to 69, was wildly successful. I mean, the numbers are amazing. An average annual return of 37.1%.
Unbelievable numbers. But he was doing it by taking on massive risk, massive leverage, doing these really aggressive arbitrage deals, like the one with British Columbia Power.
He was aggressive, he was using debt, and he got spectacular results.
Until he didn't. Until the market crash of 73, 74 hit.
That was the crucible.
It really was. The market declined almost 50%, and Munger's losses were so severe that he had to close the fund in 1975. It was a crushing, humiliating experience for him.
I think we sometimes forget how painful that early failure must have been, especially given his later reputation for being so cautious.
Oh, losing everything you've built. It must have been terrifying.
It really hammered home that lesson he learned playing poker but had sort of forgotten in the bull market.
What's that quote?
Life, in part, is like a poker game, wherein you have to learn to quit sometimes when holding a much-loved hand. That volatility, it just fundamentally changed his tolerance for risk and debt.
It did. It's probably the single most defining failure that informs all his later success. He realized that leverage in a cyclical business is it's a recipe for disaster.
Yeah.
The goal changed from maximizing returns in the good times.
To just surviving the bad times with maximum flexibility.
Exactly.
So we transition from that early volatility to the mature conservative Munger strategy. And the first thing you notice about this philosophy is that it's less about trying to be a genius.
And more about just avoiding major errors.
Yeah, avoiding stupidity.
This is where the wisdom really shines through. His first major pillar is focusing on what not to do. He says, people are trying to be smart. All I am trying to do is not to be idiotic, but it's harder than most people think.
Right.
And that avoidance of idiocy, it implies extreme patience. He doesn't chase hot stocks. He doesn't jump into fads. He just waits. Waits for the market, which is so often short-sighted, to temporarily underprice a company's long-term economic value.
And if you look at his track record, he's admitted his big mistakes are rarely the things he bought.
No, the things he didn't buy.
They're errors of omission. He saw a good investment, he knew it was good, but he didn't act or didn't buy enough because he hesitated. It's a very different kind of risk management.
Exactly. An error of commission is buying something bad and losing money. An error of omission is it's choosing to wait, being right in your analysis, but then failing to pull the trigger.
And this is directly tied to the next pillar, his circle of competence.
Crucial concept.
Which is really just the boundary of what you understand, isn't it?
Precisely. Munger has a great line. Knowing what you don't know is more useful than being brilliant. This is what guided his decision to completely avoid the tech bubble in the late 90s.
While everyone else was getting rich.
While everyone else was getting rich, temporarily, he realized those internet businesses were outside his circle of competence. So he and Berkshire just ignored them, even when other investors were calling them dinosaurs.
That takes incredible strength to stand apart from the crowd like that.
It really does. And that strength translates directly into the next core pillar, patience. But patience backed up by immense resources.
He sees waiting as an asset.
A huge asset. It's waiting that helps you as an investor, and a lot of people just can't stand to wait.
And the physical manifestation of that patience is
Cold hard cash. Munger personally says you should keep, $10 million in cash reserves.
And on a corporate level.
At Berkshire, it's famous. They keep this immense reserve. Our sources noted they've held upwards of $72 billion.
Just sitting there.
Just sitting around, earning next to nothing, waiting for the right deal.
Wait, holding $72 billion in cash while the market is ripping higher? That takes an insane amount of emotional and institutional discipline. How do they justify that, accepting such poor initial returns?
It's the ultimate trade-off. They accept the poor, safe return on cash today, maybe 1%, for the chance at years of massive high-teen percentage returns later.
When a crisis hits.
When a crisis hits, and they can deploy that capital instantly. This approach it's completely contrary to the institutional norm. Most managers are judged quarterly.
Right. They feel pressure to do something.
Exactly, to justify their fees, which often results in them doing something stupid. Munger sees that institutional pressure as a flaw he has to constantly avoid.
And that discipline on where they place their bets, that leads us to portfolio structure. Munger absolutely dismisses the standard advice of heavy diversification.
Oh, he hates it. He calls it crazy.
His quote is, "This worshiping at the altar of diversification, I think that is really crazy."
Yes. The mainstream idea of buying 50 or more different stocks, it just guarantees you'll mimic the market average. Your winners get canceled out by your losers.
So what's his alternative?
He argues that if you've done your homework and you truly understand a wonderful business, you should concentrate your bets, 10 or fewer companies, places where the odds are overwhelmingly in your favor.
So if you've done the work, diversification is just ignorance.
That's essentially his view, yes.
That philosophy of concentration, it hinges entirely on this critical departure Munger made from Ben Graham's traditional value investing.
It does. Graham's methods were, they were rooted in fear, shaped by the trauma of the 1929 and 1932 crashes.
So he was all about asset protection.
Purely. He sought a margin of safety by buying assets for less than they were worth in a fire sale. Buying stocks for 50 cents on the dollar because he knew he could liquidate the business and get $1.
Which means you have to sell as soon as the price goes up.
You have to sell. It's purely transactional.
But Munger realized the fatal flaw in that. It completely misses the power of compounding a great business.
Yes, he admitted, and this is another great quote, once we'd gotten over the hurdle of recognizing that a thing could be a bargain based on quantitative measures that would have horrified Graham, we started thinking about better businesses.
This is the moment they stopped being traders.
And became permanent owners. The Coca-Cola investment is the perfect illustration of this mental shift. Berkshire, bought Coke in 1988.
At a price-to-earnings ratio of 18, which Graham would have hated.
Never would have touched it. It looked way too expensive based on current assets.
So if it was expensive, why on earth did they buy it?
Because they didn't see it as a stock. They saw it as an equity bond.
An equity bond? What does that mean?
They calculated the initial earnings yield, the return on their investment, at 5.5%.
Which is a good return for a safe investment.
Right. But crucially, Coke's earnings were growing at about 16% a year, so they realized they were buying a perpetual bond with an interest rate that went up every single year, indefinitely.
So you're treating the stock like a perpetually increasing income instrument. You buy it once, and then you just let the magic of compounding earnings do all the heavy lifting for you.
Precisely. You hold it forever. And the results, they speak for themselves. That original $1.3 billion investment has compounded so effectively that by 2015, the annual dividend alone provided a 40% return on their initial cost.
Wow.
You didn't need to trade it, they just needed to own it.
And that focus on quality, on a business that compounds easily, that's the core of the durable competitive advantage. Munger states it so clearly. A great business at a fair price is superior to a fair business at a great price.
And the case study for this is See's Candies.
Which is partnership purchased in the 70s. See's was the revelation. It codified the entire strategy. They discovered that See's had such powerful brand ownership, this emotional attachment consumers had, that they could raise prices 10% a year and no one cared.
The brand loyalty created these enormous margins.
And required almost no new capital. The high margins weren't competed away.
That's such a stark contrast with what he calls bad businesses, like airlines or department stores.
Where competition just forces price wars.
Right. Those businesses constantly throw up painful decisions time after time because they have no competitive edge. A wonderful business, like See's or Coke, it throws up easy decisions.
Raise the price, pocket the cash.
So if you're trying to figure out if a business is wonderful or if it's just pretending, Munger offers a key valuation warning. It's aimed squarely at management who try to, fudge the numbers.
He really pulls no punches on this one.
What does he say?
He says, I think that every time you see the word EBITDA, you should substitute the word bullshit earnings. Wow, bullshit earnings. So what is he seeing that's being missed when companies report that number?
He's saying they are ignoring reality. EBITDA earnings before interest, taxes, depreciation, and amortization. It's designed to make a company look better by excluding real costs.
Okay.
Interest and taxes have to be paid now, and depreciation and amortization, those are just accounting terms for the cost of your assets wearing out.
So you have to pay for them later when you replace the factories or the machines.
Exactly. You can't run a business for long without replacing capital. Ignoring these very real costs gives you an unrealistic, a fictional view of a company's true economic nature.
The need to avoid these unrealistic views, it brings us directly to what Munger calls the dementia in modern finance.
Yeah, there's a great quote on this.
He says, there is more dementia about finance than there is about sex. He means that the quick forgetting of recent financial disasters leads people to repeat the same follies over and over again.
Absolutely. The market is designed to have cycles, boom and bust. And while Munger is always prepared for the eventual correction, he never pretends to be a psychic.
He doesn't try to time the market.
Never. He admits, I've never been able to predict accurately when a crisis will hit. The key is structural resilience, not accurate timing. It's being prepared by having cash ready when that predictable eventual implosion occurs.
And he attributes a lot of those implosions to two factors that interact viciously: complexity and leverage.
Yes. Where you have complexity, by nature you can have fraud and mistakes. He points to institutions like Lehman Brothers, like AIG, where the financial statements and the derivatives were just intentionally too convoluted to understand.
So they were hiding massive risk.
Hidden in plain sight. And the famous collapse of the long-term capital management hedge fund in 1998 is the ultimate example.
Right, LTCM.
It was run by geniuses, including Nobel laureates, which proves that even smart people aren't exempt from professional disasters from overconfidence.
A fund run by Nobel laureates collapsed. I mean, that sounds impossible, especially if they're experts in rational economics.
And that's precisely the point. Their system was technically sound until an unpredictable event, the Russian financial crisis, broke all their models. But the real villain was leverage.
How much were they using?
They were borrowing massive amounts, something like $120 billion on just $4.7 billion in equity.
That's insane leverage.
So when the trades went wrong, they had zero margin of error. The whole structure just collapsed overnight. and it required a federal bailout to save the entire financial system. Munger sees that combination of overconfidence, complexity, massive leverage as the hallmark of impending disaster.
And he argues that this tendency towards disaster is driven by the very structure of the investment management business itself.
Which he calls insane.
Right.
It's all about incentives. Managers feel they have to promise impossible returns, 20% or more, just to raise capital from investors like you.
And once they have the capital,
the pressure is on to perform immediately. And since it's not their money, they feel compelled to leverage up and throw the dice to chase those high returns.
so if they win big, they get huge fees.
And if they lose big, they just raise a new fund. The risk is asymmetric. It favors the manager, not the investor.
But that folly, that whole insane structure, it creates the very opportunities that Munger waits for.
Exactly. When the market tanks, Munger says that's the draining of the barrel and makes it easier to see the underpriced fish, the great businesses that get dragged down with the tide.
You had to be ready.
You have to be ready with that massive cash reserve. He reinforces the idea that if you aren't buying like crazy when you have the opportunity to buy a business that has a huge potential, it is a big mistake. You have to be aggressive when everyone else is fearful.
Munger offers this simple but profound wisdom that really extends beyond balance sheets into career and life. He has 3 rules for a career that kind of distills his whole ethics.
They're so simple.
Number 1, don't sell anything you wouldn't buy yourself. 2, don't work for anyone you don't respect and admire. And 3, work only with people you enjoy.
And maybe his greatest personal success comes down to compounding knowledge, which is really the flip side of compounding money. Munger attributes his success and his long life to following this advice. Spend each day trying to be a little wiser than you were when you woke up. By committing to continuous learning, to reading, that knowledge, just like money, compounds exponentially over a long life.
And it all starts by acknowledging what you don't know.
Exactly. Defining your circle of competence. That's the very beginning of wisdom.
So what does this all mean for you, for the learner? Munger's entire philosophy, it seems to come down to this deceptively difficult balance between 2 opposing forces.
Yeah, it's a real paradox.
Successful investing and maybe a successful life. It requires this crazy combination of gumption and patience. The ultimate takeaway here is that intelligence isn't enough. You have to cultivate this profound discipline to just sit on your hands and wait, sometimes for years, while the rest of the herd runs right past you.
But if you can master that mental discipline,
you will be prepared to pounce decisively and aggressively when the next great but brief opportunity inevitably arrives.